6 o'clock in London, it's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Anyway, greetings, good morning, good afternoon, and good evening. And if you're in Mumbai, hello to your guru. Presumably, if you're in the world of exchanges, depending on where you are in the world, we wish you hearty greetings. My name is Patrick L. Young, the IPO-VID Livestream, Series 10, Episode 2. If you've counted through your fingers and thumbs, that makes Episode 56 starts here. In the parish, congratulations to Chairman James Miller and the New Zealand Exchange team, who acquired 33% of Fonterra's global dairy platform this week, with EEX of Deutsche Börse fame acquiring an equivalent stake. New Zealand Exchange have already raised some 16 million New Zealand dollars, that's 10 million US, from the institutional component of an accelerated book build. The book build opened to retail today, so let's see how much money they can manage to raise for their future acquisition strategy. Lots of exciting jobs moved this week. First up, all the best to Nasdaq's departing EVP of Market Infrastructure Technology, Lars Ottersgaard, and hearty congratulations to Roland Chai, ex of LCH, ex of Hong Kong Exchanges, on becoming the new EVP of Market Infrastructure Technology. Over at TradeWeb, all the very best to co-founder and CEO Lee Oleski, who's heading upstairs. He's already chairman of the company. He's going to be CEO until the end of the year, when he's going to relinquish that role to the longtime president Billy Hult, who therefore becomes a man in his own right again following his ex-wife's affair recently. In new market news, the BSE have gained the nod from SEBI for a gold spot exchange via an in-principle permission for electronic gold receipts. Back in Germany, there's no big deal on the horizon from DB1. That came in the same week as Deutsche Börse's CEO Theodor Weimer added to his burgeoning portfolio of non-executive board positions, with a seat as a director of Knorr-Bremse, the brake manufacturers. With no M&A apart from its exciting EEX subsidiary, it's perhaps fair to suggest that DB1 intends to bore exchange parishioners to death with a variation of the CME's own dynamism. All this and more, ladies and gentlemen, has already been covered in greater detail in Exchange Invest Daily, the unique newsletter of the Bourse Business. Send us an email or hit me up, Patrick L. Young, on social media, whatever stream you're watching this on, and we can get you signed up to understand the exchange business. Our guests today, Alan Swimmer and James Davolos. We are big thinking on inflation. That's the topic for today. Alan Swimmer is MD at Horizon Kinetics LLC. He's responsible for focusing on exchange-related investment opportunities. Previously, he was at Environmental Financial Products. Alan spent over 28 years in various senior roles in institutional ETD, including North American sales head at JP Morgan. He's held board positions at RMG Networks and the Minneapolis Grain Exchange, amongst others. 17-year Horizon Kinetics LLC veteran James Davolos is co-portfolio manager for the Inflation Beneficiaries ETF. That goes by the very, very catchy acronym INFL on its ticker. He's also co-portfolio manager for the Internet Fund, as well as several private funds and institutional separate accounts. James, Alan, welcome to the show. Alan, where in the world are you today?
Hi, how are you, Patrick? I'm in Chicago, where it's currently about 40 and raining, heading towards 20 and ice. So just Chicago weather.
Chicago weather, that 20 and ice was not a reference to the Intercontinental Exchange, I hasten to add, listeners. But at the same time, here we are talking about inflation. So James, hello, where in the world are you today?
Hi, really excited to be here. I'm about an hour north of New York City, not too far from Greenwich, Connecticut.
Fabulous. Fabulous place to be. And presumably it's not quite snowing there, but what's your winter weather looking like?
We're in a bit of a mild spell today. It was single digits on the Fahrenheit scale last week, but we're up in the 50s today, but it's quite wet.
Even so, that's pretty spectacular for this time in February. It's not too bad of weather for that part of the world. So look, it's great to see you all together, gentlemen. Thank you very much. Greetings, Anthony Clancy. Good evening, all. Lovely to see you, Anthony. Delighted you could join the show. If you've got any questions or comments you'd like to make about the show, join us on social media, wherever you are today. We'll be delighted to take your questions, particularly in relation to, of course, inflation. And hello, Liam Moore. Great to see you as well. Thank you very much for joining the show this evening. So, explain to me a little bit. A lot of people may not have heard of your firm. So, Alan, maybe you could give us a little bit of a background to the whole Kinetics business.
Sure. So Horizon Kinetics has been in business over 25 years. I would call us a classic value dormant asset manager with a research background. We started as a research firm 25 years ago where we published and sold research. And we currently today still have a research business that supports a lot of our investments. We have about $7 billion under management in sort of a variety of products such as traditional mutual funds, our one ETF, and then a bunch of different private partnerships or single entity investment groups.
Very interesting. And so, James, I mean, that brings you in. You're one of the co-portfolio managers. Sounds like a very interesting world, the different things that you're managing.
Yeah, I think one of the strong points of Horizon is that the team is set up to look at really unique structural inefficiencies in the market and things that people don't properly understand en masse. And it's apropos being here on your program because it's wild to me the level of misunderstanding about the business model of financial exchanges, given that most of the people in this are in the financial services industry. They don't understand what a wonderful business model it is, especially as we're starting to see all this inflation coming through.
I have to say, I'm really gutted at this point in time. I don't have a couple of tambourines and say the Salvation Army or some other sort of band. We could go, hallelujah, praise the Lord, because you're absolutely right. I mean, exchanges are the best, as far as I'm concerned, business model around at the moment. And I mean, you look at it, they're the epicenter of e-commerce. I mean, all these things like Airbnb, Uber, etc. What are they but exchanges? And it's a great business, and it isn't great business as well for inflation. We're going to come back to inflation in just a minute, though. So, you've built this ETF. Now, hold on a second. Let's take that back a few steps. I mean, how do you manage to come to the idea one morning and just go, let's make an ETF, let alone what that ETF is going to be? Alan?
So, interestingly enough, the firm has been concerned with inflation and actually debasement of currency for the last 4 or 5 years, actually. Even prior to COVID. And that idea has been displayed in, many of the names that we've invested in over the last several years and written research on. And when COVID happened, we as a group sat around and said, hey, this is sort of a time where there might be potentially more inflation than we had even expected and had been thinking about for the last few years. And you add on $5 trillion in stimulus, and we realized there's going to be a real situation here. And what the team sat down, we said, look, we have a lot of names that we've followed and invested in for many years, but we don't really have any products that really can directly address an inflationary period. When we looked out into the landscape, we said, well, what exists out there for investors to invest in if there is inflation? And the typical things come to mind, either tips or tips-based portfolios, base metals, or energy. And so that's sort of what's been existing in the marketplace if you want to address inflation. The issue with those is that you, first of all, each of those topics are binary bets on inflation. And in order to get inflation and address it with those type of investments, you really have to have inflation. Actually, tips, which we've seen a lot of inflows in over the last year or so, has not performed that well at all based on the shape of the yield curve and where we are in the interest rate environment. So we want to come up with a portfolio that would, enable investors to directly benefit from inflation, but not be a binary bet. And so we sat around and said, how do we do this? And so the team, spent a bunch of time looking at what was available in the marketplace and sort of came up with Inflation Beneficiaries ETF INFL.
Okay, very interesting. Now, just run us back through one thing, because I know we've got a lot of viewers at the moment who are coming out of the UK and Europe. Tips might not be something that they're used to. So, Alan, just quickly give us a definition of the tips, please.
Well, tips is basically a product that addresses inflation directly through, looking at CPI. And historically that's been sort of the catch-all, where if you thought it was going to be inflation, you would buy a Treasury TIPS portfolio, and you could address inflation directly with that. Unfortunately, that hasn't worked out that great because we've had, negative interest rates, basically, if you look at CPI and where the curve is now.
So, okay, that's really interesting. And actually, James, I mean, that brings us, therefore, taking a step back while you're still working your way through building this ETF. You got tips, you got things that are based on CPI and so on. But of course, I mean, in America, you've got two massive degrees of inflation. I mean, you've got a CPI number, you've got a PPI number. Most of the rest of the world have something similar. How do those measure up? And in fact, what's the best one to actually be trying to look at?
Yeah, that's a great question. And I think that one of the issues with TIPS, so Treasury Inflation Protected Securities, is that the government offers to protect your principal and your coupon with CPI. And not even, a lot of people, again, I talked about how people don't really understand exchanges. A lot of people in this industry don't know that TIPS were actually only created in the late 1990s by Larry Summers, supposedly for Ray Dalio, so he could put it in his all-weather portfolio. But basically what it is you're discounting multiple things. One is the absolute level of the 10-year bond relative to inflation expectations. So there's a lot of ways to lose here, one of which is if CPI doesn't properly capture what's really happening with inflation. And so to your point, what's the right measure? CPI, PPI, the PCE deflator, there's all these numbers that are out there, but I'll just give you one quick anecdote or two. They just released the December number here in the United States for CPI, which is produced by the United States Bureau of Labor Services, the BLS. There's an addendum at the bottom which says there were 70 adjustments due to anomalous behavior and pricing over the last 12 months. So you might take pause and say, hey, maybe inflation is higher, maybe it's lower. If you're adjusting 70 variables, what was the actual experience? But the other thing in CPI that I think is really extraordinary is that they don't take the actual home price or rental prices. The number one measure in about 33% of the composite is shelter. The biggest component of that is what they call owner's equivalent rent. So instead of the Case-Shiller index, which was up north of 15, 18, maybe 20% last year, the owner's equivalent rent figure, I believe, was around 4%. So that's 1,600 basis points of spread for your shelter, which is a very huge portion of many Americans, especially those in gateway cities, a cost of living expense. And that was understated by a factor of 4. So again, there's a very large, you need to really look at what the data is representing and what is it supposed to capture versus what do you think it captures.
So that's fascinating because we see the same sort of problems in the UK. You've got index-linked gilts, which are essentially very, very similar concept to the TIPS, for example. But you mentioned, I mean, the Case-Shiller House Index. I mean, that's just if I remember correctly, that's a bold index of essentially what is house price inflation. So you're saying that the government is kind of rehypothecating what it thinks the rents are and therefore working that out into inflation and then ending up with a number that may not actually be reflecting the real picture.
Exactly. Quite literally, they would call you and say, hey, what do you think you could rent your house for hypothetically? Of course, you need a place for you, your wife, your kids to live. So your house is not on the market. Maybe you look at what your mortgage payment is relative to, hey, maybe I think I could get a little bit more. But in reality, the true cost is far higher than this survey of what people think they can rent their homes for. So that understates inflation. And there's empirical evidence going back decades of how the spread between owner's equivalent rent and the actual experienced Case-Shiller index, which literally looks at the average, median, smooth selling price for houses in different markets. And then they create a composite both regionally and then also nationally.
Quite incredible altogether when you think about it. So the government are basically behaving in the same way as when the interest rate markets did a similar sort of thing and called it LIBOR, they arrested people and put it in jail. But once again, the government gets away with it. Quite sensational altogether when you distill it all down like this so easily. Just let me break off for a second. Say hello, Linda Gustafson. Hi, thank you for joining the show, and greetings and good evening, Peter Second. Fabulous to see you on the show today. So, Alan, taking it back a step, you're putting together this idea for an inflation-linked product. You decide that you're going to make it an ETF, and you're doing that, what, during the early stages of COVID?
Right. We start, interesting enough, we had, I would say, a good idea and really great timing. We started talking about this really at the very beginning of COVID, March, April, at the beginning of COVID. And we sort of talked about the firm, and the firm had really never launched an ETF before. So we had to get up the learning curve as to sort of, all the regulatory environment and the different things that you would need to do. And so we started working on it, say, March, April, May of that year. We had a lot of meetings with industry experts and sort of white label companies to understand, how and why and what you need to do to launch this product. And, it took us, probably 4 or 5 months after that to get it registered properly, listed in New York Stock Exchange. We launched the product January 12th of last year, so just 13, 14 months old. And luckily enough, the idea was a good idea and excellent timing because, people really started talking about inflation sort of right when we launched.
Quite amazing altogether. And well, it's so amazing. Hello, good evening, Craig Richardson. It's lovely to see you on the show. Thank you for joining us. So you have this, let's face it, you've had amazing timing. That is the one thing that's quite sensational. I remember it's just over a year ago, you wrote to me and said, hey, maybe you could mention this in Exchange Invest because we're putting out this first inflation ETF. And I thought, that's a great product. And, in a couple of years' time, I think that's going to go really well, which just goes to show that I can be spectacularly wrong, ladies and gentlemen. At least I should stick to just prophesying thing about exchanges. It's much better than trying to forecast inflation because it's exploded during the course of the last year. And that's quite an amazing situation altogether. So, Alan, just go back. In order to build your first ETF, how difficult is it?
Well, it wasn't as difficult because, as I mentioned, the firm's been in business for 25 plus years. We have, several listed mutual funds. So we've got an excellent team of compliance and lawyers and operations in place already for the traditional type mutual funds. So we had a great, infrastructure internally to be able to manage and launch funds. There were just some particulars by being listed on New York Stock Exchange that we had to really understand what those were. We had to find a lead market maker and understand, sort of who and would support the product. And, so it took some time to do that. And, it took us all of that year to really get the product wrapped up and launched properly. But luckily, we had a fairly good head start because we have a pretty good team internally that, is really knowledgeable about just securities in general.
But also, it must have been quite a struggle, mustn't it? Because, you were doing this all while working from home and through the COVID pandemic. It certainly didn't make things any easier, did it, James?
No, it was definitely, I miss being able to sit down in a room and just figure things out with people. But, luckily with these new Citrix systems and remote work, we were able to do it pretty well. And I'll definitely give credit to U.S. Bancorp, where they were our custodian for decades for our mutual funds, and they have one of the best ETF practices here in the States. And so we knew who to call. They plugged us in. They were really effective. So it's pretty impressive how quickly you can get things done, where from once you pull the trigger and you're ready to go, you could launch an ETF here in about 3 months if you have your act together.
Wow, that's quite incredible altogether. You could launch it in 3 months. So I feel like saying, well, hello, Simon Huckle. Everybody's out for my daughter's birthday meal this evening, so who's going to catch us up later? Well, just think if only you'd been preparing sometime last December, you could have had an ETF for her birthday. I mean, that would have been something special. Hope your daughter's able to celebrate with us tomorrow, because obviously we're very keen on girl power. You can also catch, of course, Women on It on their channel tomorrow evening at midday Eastern time. That's 6 p.m. in European time. So looking at this whole inflation scenario, and I'm waiting for your questions, ladies and gentlemen, ask away. You've got the experts in the room. Love this quotation from Milton Friedman, incidentally. I mean, a genius personified. Inflation is taxation without legislation. So, gentlemen, you've launched this fund. How do you intend to manage to help investors defeat the bogeyman of inflation, which, let's face it, just like, I don't know, totalitarian dictatorship, everybody seemed to think had died out 20 years ago?
James?
Yeah, I think a lot of people can hypothecate who can push on costs in inflation. So sure, can Apple charge more for an iPhone if inflation is 10%? Probably. Can the grocery store mark up bananas and chicken? Yeah, almost definitely. Can automobile companies pass on costs? Almost definitely. People need cars, they need chicken, they need bananas, and a lot of people really like their iPhones. They're on them all day. But not many people then think about the other side. What are your costs? And so there's two forms of costs. Your cost of goods sold, which is directly influenced by PPI, so your producer price index, meaning how much more is it going to cost to get your microprocessors, your manufacturing, your shipping. You've heard of all these delays at ports. So those raw materials. Then if you go really, really upstream, then you start looking at the raw materials that create the intermediate materials. Now you're talking copper, oil, gas, iron, aluminum, things like that, where now you can get really, really deep into how deep the supply chain issues actually run when you go up fully upstream. The other area is your SG&A, so you're selling general and administrative. So these are the services. If inflation's higher, your marketer is going to want more, your lawyers are going to want more, your tax accountants are going to want more, your employees are going to want more. So it's really difficult to have a company where their revenue can inflect without a commensurate or greater inflection in those big cost items. So you're lucky if you can maintain margins. But what we want to isolate, identify the companies that have exposure to the inflationary end markets where the revenue inflects, but with minimal or no inversion in the costs. And again, I'll go right back to the exchanges. If volatility goes wild and they do a couple more $1 trillion of volume on the CME, the LSE, the Deutsche Börse, the ASX, maybe you plug in a couple more computers and pay your executives a little bit more bonus, but margins expand. And that's what you want to capture. And that's kind of the genesis of almost all of the business models in this fund, which really differentiates it from, I think, a more traditional mindset of buy energy, buy gold, buy real estate.
So that's really fascinating. So what you're talking about then is something that's not just a knee jerk, aka so many people say, oh, there's inflation. And as you say, they go buy precious metals. I mean, Alan, the idea therefore is obviously to try to get beyond just a sort of a flat earth view of inflation.
Sure. I mean, look, you can buy precious metals, you can buy energy. The biggest issues with those are a fewfold. First of all, it's timing. You could be correct in your thesis that there's going to be inflation, but you might not time that exactly right, and you might buy either base metals or energy and time it improperly and have inflation and not have entered the position properly in terms of time and lose money. Additionally, the other ways to invest in either energies or base metals is you can go into either ETFs or go into ETFs that might have futures contracts in there. And the problem with those is, depending on the shape of those futures curves, you either have, contango or backwardization. And so you could be proper in your idea, and based on the curve and what's going on out in outward months, you could still lose money. A great example would be, looking at some of the metals and gold, and ways that we've displayed gold in our portfolio. And James, maybe you want to talk about sort of how we view base metals and how we've displayed that in our portfolio. I think that's a real interesting and great example of what I'm talking about.
Sure. So the most traditional way that you would think about getting exposure to gold would be go and buy bullion. Go to the LME. You can get physical delivery there. Most exchanges are paper delivery. We'll get into that later, but get gold bars, put it under your bed, dig a hole, put it in your backyard. You have the bullion, and that's your exposure to gold. There's paper ways to do it through derivatives, where Al mentioned you buy futures. There's a cost to that. So there's ways to do. There's merit to owning physical. There's merit to owning futures, but to get a levered or a more financial interest is you buy a gold mining company. So the gold mining company digs up the gold, then they basically have all their costs, they sell it, and then they earn cash flow. And the beauty of the gold miner is that they have actual cash flow they can distribute to you as a shareholder. You can then put that in your pocket and buy gold with it, buy bread with it, buy a car with it. The problem with the gold miners is, I mentioned before, there's leverage. There's upside leverage and there's downside leverage. So right now you have to really look at what's the reserve life, what's the all-in sustaining cost. But I mentioned before, their break-evens are going up by virtue of higher expenses. Our nuanced business model for precious metals is what are called royalty or streaming businesses. The biggest companies in the world are in Canada, Franco-Nevada, Wheaton Precious Metals, but in a very simplified version of how these companies operate, they have contractual agreements to get a fixed percentage of the gold and silver and platinum metals that come out of each mine, where either they get it cost of any expenses whatsoever, or they have a highly discounted purchase price relative to spot. So in this sense, you have a very, very low break even. You have a ton of operating leverage as prices go up. But because your returns are so high, you don't need to have debt, and you don't have a lot of capital tied up. And so, as Al mentioned before, these businesses can scale tremendously and compound through many different parts of the business cycle. So they're really a lower risk, higher operating leverage way to play a space that I think is longer term definitely going to be pro-inflationary.
I think furthermore, James, maybe you should, talk about, the last time, gold in 2010, where it is today, and how that's performed versus miners versus some of these royalties. I think that's really demonstrative of this thesis.
Sure. So, and this is not cherry picking. This is going back to the last gold cycle. So in 2011, certainly the viewers in Europe will remember this. Gold got up to close to over 1,900 an ounce because we were worried about the peripheral European debt crisis, the Portugal, Italian, Greek debt, Spanish debt. That was kind of a safe haven. But since then, the gold price is now back around just under 1,900. So you've gone 11 years and your money has been flat. So in gold itself, you've basically had money that's done nothing for over a decade. And while whether you were in debt or equity, you've done tremendously well. However, if you had bought the largest gold miners index, the Van Eck Gold Miners ETF, on that top day in 2011, you're down over 50% today, because the miners had debt, the miners had to sell assets, a lot of the miners had a very near bankruptcy experience. However, if you'd bought the largest gold royalty company that I mentioned before in Canada, you're up approximately 230%. Because they had no debt, they had no working capital requirements. They were able to go out and buy new assets, but then their miners actually overproduced in their mines because they had no capital budgets to go elsewhere. So that shows the real power of the business model through what was not a great cycle for the metal or the miners themselves.
That's really, really interesting. I mean, when you look at that. So therefore, what I'm getting as a vibe here is, clearly at the moment, this is a great moment for inflation. Therefore, your fund should do really well. But you're trying to develop a product which is going to therefore enhance a portfolio over the full cycle. Am I right, James?
Yeah, the portfolio is designed to be, I would say, a hedge against inflation. It wasn't designed to be a binary bet. So, all the names in the portfolio go through a rigorous valuation models that the firm has developed. And that's really important. And we think that you can hold this ETF through full business cycles, not just an inflationary period. If you get inflation, it's should do very well. But if you don't get inflation, you have a very good value-based portfolio of equities that should do very well through full business cycles.
That's really, really interesting. We had a fabulous quotation I saw streaming earlier on. I'm not sure where we've got that, but I do believe it was Ernest Hemingway we were quoting just a couple of moments ago, if the production team can find that, because it was fascinating insight into the inflationary mindset from 40, 50 years ago. The first panacea for a mismanaged nation is inflation of the currency. The second is war. Both bring a temporary prosperity and permanent ruin, but both are on the verge, or both are the refuge of political and economic opportunists. Well, thank goodness we're not in that sort of a scenario today. That's all I can say. Just one of those things from the period of Hemingway that just once again aren't happening in the digital age. So thankfully we can be super optimistic. Good evening, Sachin Patel. Lovely to see you again this evening. Thank you very much for joining us. Okay, so let's go back to this fascinating discussion. We're talking inflation. As you can see, they're living up to their description already. Big thinking on inflation from the Horizon Kinetics team. You put this together, you launched it into the market. As a matter of interest, what's it like actually launching an ETF in the middle of a COVID pandemic? You've got your lead market maker. How do you go about marketing it, promoting it, getting the message out there?
That's a great and unique question, because historically, I think when anybody launches a fund, whether it's a mutual fund, a hedge fund, an ETF, the best thing you can do is go meet with potential investors, clients, people with brokerage firms, RIAs, family offices, individuals. And with COVID, the ability to meet with people in person was non-existent. What we did do is use, Zoom and products like that for meetings, which was quite helpful. Social media and the ability to use social media and reach and access different people really helped us a lot. We've been able to have a lot of support from the marketplace and appear on many, many podcasts or webinars, sort of like what we're doing today. Fortunately, because there's a unique product and firm's been around for a while and have had some nice friends, we've been written up in many periodicals. We've been on, CNBC a bunch of times and mentioned in Grant's Interest Rate Observer and some of the, more thoughtful places where, portfolio managers look to for ideas and thought. And we've been, supported greatly by a lot of people, in the media and friends from the industry. So while we haven't been able to, get out there and, meet with people in person, we've, taken advantage of the ability to do it via Zoom. And, it's worked out pretty well.
It's absolutely fascinating altogether. So also tell me then a little bit about that, because hasn't there been a lot of dynamic change, Alan, in the whole RIA space anyway in recent years?
Well, I think the RIA space is booming, and what's interesting is I think a lot of the RIA space is growing because a fair amount of the wealth managers sort of decide they didn't want to be on the platforms for a variety of reasons. I think some of the reasons were product offerings. Some of the platforms, you're very limited on what products you can sell or have access to for your clients, and some of the larger groups have left the large platforms to start their own RIAs or join, existing RIA space. The RIA space is booming now. There's been a fair amount of new ones and also a fair amount of larger companies doing roll-ups of the large RIAs. And so, they're less constrained about the products they can offer their clients, they can offer their family offices that they're managing money for. And so they're able to think outside the box. In order for our product to get approved in an RIA, depending on how big it was, there's obviously a diligence period, but then the principals of that RIA could decide within a week or a month or a few months after they saw what we were doing in our track record and understood our portfolio, we could be approved. A lot of the larger platforms, the large banks, investment banks have, different, restrictive requirements, such as certain AUM or certain amount of time in marketplace. For example, there are certain platforms that wouldn't even, speak with us or look at our ETF until we were, aged for a year. So, we haven't really counted on the large platforms to date for, the raising assets. It's really been sort of, some of the alternative places like the RIA space.
Very interesting. And therefore, being on an exchange, does that make a dynamic difference to how you actually go about marketing the fund?
I mean, it's a very easy thing to market because it's listed on a New York Stock Exchange, and it's a portfolio of fully listed stock, so it's very transparent. So Not really.
Okay, great. It's quite interesting altogether. I see our production team are throwing all manner of exciting quotations at us at the moment. I'm rather excited to see we've got, well, a pianist and a politician. Let's see if we can manage to work out which one's which. Let's start with the politician. There are only three ways to meet the unpaid bills of a nation. The first is taxation. The second is repudiation. The third is inflation. Well, this time it's different, clearly. Gosh, that could make a good book title, couldn't it, I suppose? And the other one, which is quite interesting, alongside Herbert Hoover, we've got Victor Borgia, the fabulous concert pianist turned humorist. I don't mind going back to daylight saving time. With inflation, the hour will be the only thing I've saved all year. Yes, we all sort of feel that way as it eats into our wage packet as we go through the month. So, James, obviously, you put the portfolio together. Can you give me an idea? I'm not asking for all your secret sauce, but is your concept that you hold for quite long periods of time, or are you willing to move quite speedily through different stocks depending on the cycle?
Sure. And I think the name of our firm, Horizon Kinetics, the genesis of the name Horizon back in 1994 was that when the partners left the big institutional framework of large Wall Street banks, they said, look, our number one advantage is that we're going to extend our time horizon. So if we know that these businesses are going to be achieving record profits and that they're undervalued, our advantage is that we don't need to get paid and have that to come to fruition within an artificial time horizon, i.e. 1 year. So everybody is remunerated based on the December 31st calendar year. We believe that if we're not as focused on that year end or that 6-month catalyst, that we can earn a much higher discount rate. So much the same way that there's a very well-known and recognized discount rate in a properly functioning bond yield curve, where the discount rate goes up with time, we believe that also exists with stocks with no identifiable catalyst. And so that's kind of a circuitous way of saying that we absolutely hold for the long term. I would imagine that everything in this portfolio we're holding with a minimum time horizon of 3 to 5 years. But given the nature of inflation, I'd say that we will be a little bit more dynamic here. Just for example, year to date or since inception, energy's done fabulously well. Precious metals has kind of languished. So, if we start going into less of a pro-cyclical market, let's say there's a possibility, I think we could see slightly lower real economic growth, perhaps even slightly lower reported inflation numbers in the back half of the year. It might be a period where you might want to reposition a bit more into gold. And so at the margin, I think we'll do things like that, but the core portfolio is going to be extremely low turnover.
Okay, so the core portfolio is extremely low turnover. I'm just interested. How do you play, or can you play, things like, well, the huge containerization crisis of last year, where suddenly we saw the whole cargo network getting clammed up and the cost of freight was going through the roof? Is there a way to include that into your portfolio?
There is. I mean, it's not that scalable, but I think the most eloquent business model where you can capture that is brokers. So think about the shipping companies where, yes, they make a lot of money when the cycle is strong, but it's been vastly overbuilt, where the Baltic Dry Index had never recovered even close to its value before the Great Recession until COVID, when it actually got near the pre-global financial crisis high. But the problem with container shipping is all shipping for that matter, it's extremely capital intensive, it's extremely cyclical. And so it's difficult to actually own it long term. But brokers are a wonderful business. And there's the largest publicly traded ship brokers are in the UK. And think about their revenue model. It is volume times price. So if everyone's desperate to charter a vessel, there's more volume. And if there's no supply, then that price goes up. So volume times price is the revenue function for the broker minus the fixed cut for the broker, him or herself. So really wonderful, eloquent business model to capture something that's really difficult to invest in directly, given the nature of the shipping industry.
That's fascinating. And of course, that is a big issue. I mean, you hit on the scalability point. So are there other touch points or pain points of particular industries that are very difficult to get scale into, even though they suffer extreme inflation?
Yeah, I think one that is going to be one of the most hot topic issues, probably sooner than most people think, is going to be agriculture and food prices. So again, to go back to how the U.S. reports inflation, I think that they reported food around 7% last year. But the United Nations publishes an FAO food index, and that was up about 20% last year. So obviously that's an international number versus a domestic US number, but food prices are going up. And if you think people get upset about fuel prices going up, you haven't seen anything yet until food prices go up. I mean, that's the spark to a lot of coups, a lot of huge social unrest, and the seeds have been sown, pun intended, for a food shortage. We have not planted enough, but also more importantly, the world, especially the non-OECD, so the developing world, every one of those governments, and as they should, is pursuing policies that grow real GDP on a per capita basis. There are two truths with rising per capita GDP. One is higher energy consumption. The other is higher agriculture or caloric/protein consumption. So you can argue what the mix of ag and the mix of energy is going to be, but the trend is higher. So to tie this back to inflation, ag is really hard to play. Farmland hasn't worked because the farmers can't make any money because their input costs are so high. I'm actually hearing a lot of stories about farmers foregoing plantings because their input costs are too high. The fertilizer companies are incredibly volatile. I think potash is interesting, but when you get into the nitrogen and fuel-based fertilizers, it's incredibly cyclical because it really is just a commodity. There's no value add. The seed and crop technology companies are basically just biotechs with a huge research and development budget. So we actually find that choke point in the processors. So the companies that process all of the world's corn and wheat and soybeans, and then they process these into finished starches and sweeteners and olefins, and then they sell them to the end customer or intermediate customer who then puts that into a finished good. So why is this business model so good? And the reason is that they are the toll booth, if you will. So they procure the world's crops. Then they put them into milling or crushing facilities, which is the toll booth. Then they sell them for a spread to the intermediate or end customer. But basically that spread is fixed around 3 to 5%. So if all those prices skyrocket, basically they're making the same margin on a far, far higher revenue line. So it's a really great, eloquent business model and mousetrap. And this is actually scalable. And just so happens that these trade very inexpensively on a cash flow basis.
Okay, but actually, I'm curious about that because, funnily enough, I just happened to have sat beside the man who used to be the master of the worshipful company of bakers until very recently, and he has a big company in actually that food processing area. Isn't there a problem though, because a lot of these people are on quite long fixed contracts, so therefore they're dealing with supermarkets or they're dealing with other processors, and actually therefore there's a lag at the point at which they can actually go forward and raise their prices, and it's not necessarily therefore now which is hitting their margins, but it's going to be in 12 to 18 months time when they start to renegotiate.
Mm-hmm. So yes, this is actually one step further upstream of that type of business model. So these are the Archer Daniels Midland, the Wilmar, the Bunge. Glencore owns a large company called Viterra. The largest in the world is a private company called Cargill, except for the Chinese state-owned processor. But they're literally procuring the corn directly from the farmer. So then they crush it at basically the spot corn price is their procurement cost. Then their margin is based on that procurement cost of where the commodity price is. The intermediate processors, which then might take that flour or that refined starch into baking products or pizza crust or something else, they're a little bit more tightly wound with the contractual basis in terms of their longer term contracts for supply.
Okay, that really clarifies, actually. I think that's very, very helpful. But obviously, of course, for your fund, which is anyway going through a full cycle, you can live with the idea that some people may get their margins slightly turned down, first of all, because you can buy for the long term and therefore add that sort of alpha factor as it comes through, presumably.
Yeah, exactly. Just like there's a lot of companies that are over earning today. So a great example would be automotive dealerships here stateside. The largest public auto dealer, they were earning $5 a share in 2019. And the past 2 years, they've earned closer to $20 per share. So clearly they're over earning. A lot of that is because there's much higher margins on used cars, and those earnings are going to revert somewhere in the $10 to $12 range next year, and we'll see where it goes thereafter. But I think what's more interesting are the companies that are under earning, because you really haven't seen that the throughput yet from a lag effect. And I think that there could be a lot of opportunity there going forward, because the market hasn't really priced that in to a large extent.
That's fascinating. That's a really, really interesting point altogether. So therefore, I mean, Alan, as you're developing this fund and going forward, what are the next steps for you with this, your first baby ETF, to manage to bring it to greater fruition?
I mean, the next steps, meaning in terms of new products, I think that, the idea was that we should launch this and see how we do and get really good at one product. And I think, we've had a good year, first year. And we want to, start thinking about maybe the next idea or two that we're going to come up with. But, we want to do one thing first very well, understand exactly who the marketplace is, who's interested in these types of things, since we do think about things slightly differently than most people. And from there, then we'll start thinking about what the next product or thing might happen. But, obviously, as James mentioned, the firm has it's Horizon is in the name, and we want to think about things that are going to be longer term investments that are not, ideas that are 6 months going to be hot and on to the next. That's not what we're all about. So we're thinking about the next thing that might be a long-term trend that we could participate in and have some value add.
Okay, so actually that leads me to a great question though. James, you've already mentioned the scalability factor. What are the sort of, for want of another book title from long ago, the limits to growth on your fund?
Yeah, so we look at it in two categories. One is the average daily trading volume of kind of the least liquid components of the fund, as well as we don't want to own too much of our constituents. So we don't want to own more than, say, 6, 7, 10% of any given stock. And so within those two criteria, we think we can comfortably get up to about 5 billion. That I'd say a year ago, I would have thought that number was absolutely ludicrous, but sitting here today around 900 million. I mean, hopefully, if things all go well, this could be something we'll have to address in the next couple of years, but it scales pretty nicely thereafter. So you can look at, as you know very well, the universe of exchanges. There's so many great business models trading at great valuation multiples today that you can source a lot of liquidity there. As well as kind of other areas where I think as this cycle really take holds, there's going to be some more value opportunities to supplement above and beyond that if we're so fortunate to really get there.
I think that's a great point altogether. And don't forget, ladies and gentlemen, if you'd like to be reading daily about the business of exchanges, then do, by all means, ping me a message and we'll get you signed up for a free 30-day trial to Exchange Invest, the unique Business of Bourses newsletter. It's the water cooler read by all the leading figures in the exchange industry, all the ones delivering growth across markets, and therefore a fascinating inflation hedge. Now here's a rave from the grave. Ben Bernanke: low and stable inflation in many countries is an important accomplishment that will continue to bring significant benefits. Gosh, that suddenly looks incredibly retro, and it doesn't seem that long ago since Ben Bernanke was chairing the Federal Reserve. My, how things have changed over the course of just 10 or 20 years, ladies and gentlemen, and definitely the beast of inflation is back. So, if we're looking at this whole concept of inflation, I've got to ask you, gentlemen, give me a rough idea. Where do you think, or how bad do you think this particular inflation crisis is going to get? Not necessarily a number on inflation, although that's welcome, but how long is it going to take to get the inflation genie back in the bottle?
I mean, I'll give a brief comment, then James probably would give a better answer. One of the things that you're not going to be able to stuff back in the bottle is wage inflation. You know, a lot of companies have had trouble hiring people, and they've had to pay premiums to where they were previously paying them. It's very hard after this time to go back and say, hey, never mind, we were paying you $20 an hour. Now we're going back to $15. That's not going away. There's a lot of other things that will occur as well, but that's one of the things that's going to be very hard to change.
And I'll touch on some dangerous territory here, but say that it's going to really come down to the will of politicians. And this isn't specific to the United States or the EU or the UK or any government thereabouts, but policymakers at a certain point are going to have to choose: am I going to prioritize employment, ergo economic growth, or prices? And you're going to get thrown out of office a lot faster with a recession than inflation. So I think, plus you also have this debt burden where in all these developed countries, the easiest way to pay down your debt, you either default, you grow out of it, or you inflate. And I think obviously let's hope for the moment that any type of default is hard off the table. The limits to growth, productivity times labor force, probably we can't grow out of this. So the only other way out long term is a debasement of these currencies. And so looking at the incentives of politicians long term, I think this is going to be with us for a generation. So the days of 2% are gone. The days of above 2% are probably going to be here for a really, really long time. It's just a question of, does it really run away from itself? And one more really important thing, sorry to go on too long here, is that the trend is more important than any given episodic time series. And what I mean by that is December, year over year, you're at 7.5. In 6 months' time, you might be year over year at 4 or 3 or 5. But the trend is upwards, and the trend is far higher than pre-trend. And so that's going to have a lot of implications for businesses' margins, for interest rates, and for how to approach markets. And I think that that's the important thing, is that this is a secular shift. The same way that when Paul Volcker came in the 1980s and said, I'm breaking inflation, I think we're kind of going in the reverse now because of all those factors that I just mentioned.
Well, I mean, you're taking us back a whole generation there, aren't you? You're talking about Paul Volcker. We're going to be back to the Plaza Accord. People are going to go, the Plaza is not a condominium building. And we're going to go, well, actually, it was a hotel at the time. The whole world has changed so much over the course of those 40 years. I can't believe we managed to get this far into conversation without a crypto question. And actually, we're going to continue without one. But it's a really, really interesting point you make, because 2%. I saw a couple of things recently where they were surveying interest rate traders, and they're going, oh, we think 2% is quite a high interest rate. Now, as somebody who's managed to trade interest rates in the UK at 17% on one particular very exciting day, where it went from 10% to 17% and basically back down the next morning because they devalued, the idea of the mythical yield curve, nobody has any idea what's coming for them. In terms of what's coming for them, though, gentlemen, Alan, let me ask you, where does the revolution go next?
In terms of the industry, or
however you want to look at it?
Look, I think there's a lot of interesting things going on here. The business environment now, and one of the things away from inflation that I talk about is when I was got in the futures business in 1984 with the great Dr. Sander, who's a friend of yours, I know. There was open outcry, and there was a lot of, it was sort of the beginning of financial futures. There was a lot of money being put towards it. There was a lot of highly intelligent people trading in the pits. There was a lot of not very intelligent people trading in the pits, and there was a lot of money swishing around. I think we're sort of at that same place now in the crypto and blockchain space, where there's lots of resources being put towards crypto and blockchain. There's lots of very smart, highly skilled people participating. There's a lot of people that have very little experience also making lots of money in that space. But I think with the adoption and additional, I'd say, regulation over the next several years, I think you're going to see a convergence of, crypto and blockchain start to be, more widely accepted globally. And I think this sort of looks like the beginning of my career in the futures business. There's a lot going on, and it's, lots of craziness, but it's, becoming more mature. And as regulation and maturity comes in, you'll start to see a lot more acceptance.
Fascinating altogether. Okay, we're back to the futures possibly with the way we look at the world of crypto and blockchain and so on. James, where do you see the revolution going next?
I agree with Al, everything he said about everything with decentralized finance and all of these other blockchain-based applications. But I think taking a step back and looking at our industry, if the preconditions for the 10% return for the 60-40 portfolio since the early mid-1980s is gone, what is going to happen if you cannot just kind of latch on to that bond and equity portfolio? I think that there's going to have to be a lot of creativity out there in where we can source returns. And it's not things that are really out there today. I don't know. I think the exchanges are going to play a pivotal point here in product evolution, structured products, different types of futures and option strategies. But people are going to have to get very creative, because right now the status quo of what traditional liquid capital markets are offering people, it does not solve the problems of individual savers, pensions, endowments, sovereigns, you name it. So I think it's exciting to see what people are going to come up with over the next couple of years and decades here.
Well, that's absolutely a fascinating point to end on. I mean, one of the great points that's come out of today's discussion has been the universe of exchanges. There's so many business models trading at great valuation multiples today that you can source a lot of liquidity there, as James Davolos has said. But at the same time, fascinating that James is talking about the whole concept of the 60-40 portfolio and the death thereof, something that we've been used to living with over the course of so many years. And equally, we've broken down so many elements to the inflation issue, as Alan Swimmer was talking about. You can buy precious metals, you can buy energy. The biggest issues with that is timing. You can be correct in your thesis that there's going to be inflation, but that might not time exactly right. Those have been amongst the many topics that we've been able to look at today with our fabulous guests this evening. I just want to say a huge thank you to everybody who's participated in the show: Anthony Clancy, Liam Mull, Peter Second, Linda Gustafson, Craig Richardson, Simon Huckle, Beata Young, Sachin Patel. Honourable mention also to, amongst others, Ben Bernanke, Ernest Hemingway, and indeed I think we also had Victor Borgia, amongst other people during the course of the show. But the major thanks, I have to say today, ladies and gentlemen, goes to the Horizon Kinetics team. INFL, watch out for that. It's sort of like, could be sung to YMCA, I suppose. Horizon Kinetics Inflation Fund. We are delighted to have had two of their leading figures, an MD, Alan Swimmer, and the portfolio manager, James Davolos. They've even been willing to talk to us about, well, where the capital market revolution goes next. And I suppose, ladies and gentlemen, the truth for your portfolio is that if you don't get it right on inflation, it could be victory or death. Well, that's a gratuitous plug from me at the point in time where inflation is eating into the margins of my book sales. Thank you very much once again, Anthony Clancy. We've been thinking really, really big on inflation with Alan Swimmer and James Davolos. My name is Patrick L. Young. I'm looking forward to seeing you again next week for episode 57. On behalf of, well, my various vested interests, Exchange Invest and Valerian PLC, I wish you all a great week in life and blockchain and indeed, of course, markets. May inflation be good to you. Thank you very much.